Hello and welcome back to the Note, and we've had a very calm day on world markets today. I suspect we'll continue to have relatively calm days until after Easter, when we get a new round of data at the beginning of the new month on the economy, and then once we start getting results from the US corporate earnings season. As it stands, I'd now like to try to take a look at what has happened in the remarkable 3 months we've just had, and whether there is a sense in which the US has had its own bear market. Now, if we take a look at this chart, you can see that the Russell 2000 index of smaller companies and the Dow Transportation Index, both regarded as classical cyclical indicators which you would expect to signal economic problems ahead, to be rather more volatile in the market as a whole. Both of those have fallen comfortably more than 20% during the last 12 months and have staged a very impressive rebound of late. That, you could say, was consistent with the US having had a brief and brutal bear market, which is now over. If you also take a look at the red line here, which is the B of A Merrill Lynch High Yield Index, high yield obviously also very economically sensitive, has had by its own standards quite a sharp sell-off, and again quite a significant recovery. All of this, you could say, is in line with a shallow and brief bear market in the US, which is now over. Now, let's compare the experience in the US with what's been going on outside the US, and it's very different. If we take a look at this chart, this starts in Halloween of 2007, which is when world stock markets peaked ahead of what would turn into the Lehman crisis. And as you can see, this is very much a classic long-running secular bear market. This is what you expect after the other big market crashes in history, that it takes very many years of markets trading choppily and broadly going horizontally before you get out of the bear market. The blue line here is the FTSE All-World Index excluding the US, and you can see it's still far below its peak from 2007. Even the FTSE All-World Index, which even includes the US, is still below its peak from 9 years ago. How do we deal with this disjunction that in a globalized world, the US has only just briefly got into a bear market, which it appears to have escaped, while the rest of the world, which is behaving much more as you would expect after a market crash, has been in a bear market for the better part of a decade. We can't, I'll just make one final point, because many people will say it's the Fed's fault. Plainly, the attitude of the Fed, the reaction of the Fed in the States, had a lot to do with why the US outperformed the rest of the world in the years following Lehman. But in the last few years, other central banks have caught up. The Fed has actually ended QE and raised rates. It's hard still to blame the Fed for everything. This is a very strange disjunction, and it's difficult to resolve.